to question number 5. And we start with question number 5A. So what are we told here? We are told in relation to company law, part A, explain the meaning of the term promoter. Part B, we are required to discuss the rules that governs the pre-incorporation contract. And number C, we are required to describe the common law duties of the promoter. So we're going to start with part A of that question. And basically what we are required to do here is to define the promoter. To define who? The promoter. Remember, this is basically something we discussed in topic number 2. And actually we say the promoter in very simple terms. This is the founder of a company. This is the founder of a company. In other terms, we said a promoter is any person who undertakes to form the company with respect to a given project and basically sets that company as a going what? As a going concern, of which we say that a promoter here does not include any person who is engaged or actually who is involved in the formation of the company in a professional capacity. Meaning that if, for example, we come together, we want to register a company, maybe at a certain point we engage maybe a lawyer to be able to assist us in reforming or basically registering that particular company. That lawyer we have engaged is not a promoter because he has been engaged. We have engaged that particular lawyer in a professional capacity, basically to assist us in registering what? The company. So therefore, a promoter does not include any person who is involved in the formation of the company at a professional what? A capacity. Maybe first of all, we can say that this is a founder of a company, a founder of what? Of the company. And still we can also say that this is any person who undertakes to do what? To form the company, to form the company with respect to a given project, with respect to a given project, with respect to a given what? A project, and set the company as a going concern, and set the company as a going what? As a going concern, as a going what? A concern. And that is basically the definition, a simple definition of the term who, or basically this particular person who is called the promoter. I think that simply what was required. Then let's move to part B of the question. And basically what was required in part B is we explain the rules which governs the pre-incorporation contract. So the rules governing what is called the pre-incorporation contract. Pre-incorporation what? Contract. Pre-incorporation contract. Pre-incorporation contract. Pre-incorporation contract. Now, remember in this case, we said that when we talk about the pre-incorporation contract, these are those particular contracts which are entered into on company's behalf before the company is registered or before the company is incorporated with the registrar of companies. In other terms, we refer to this particular contract here as the preliminary what? Contract. Any contract which is entered into by the promoters on behalf of the company, but before the company is registered with the registrar of companies, is a pre-incorporation contract. Essentially, what we say is that this particular contract, as far as the company is concerned, they are null and void because they are contracts which were entered into before the company was registered. And actually, we say that until such time the company is registered with the registrar of companies, the company do not have contractual capacity. The company do not have the ability to enter into any contract. So therefore, that's what we are saying, that this particular contract, as far as the company is concerned, they are actually deemed to be null and void. They are actually deemed to be null and void. This particular contract here do not have any legal implication. If, for example, they are breached, by the end of the day, the company cannot be sued in a court of law. If the third party breaches that contract, the company cannot be able to go to a court of law, take a legal action against that particular third party. And therefore, what we see is that once the promoters have entered into this particular contract on company's behalf, then they will always be held personally liable. So if those particular contracts are breached, the company cannot be held liable, but rather the promoters, we say, are the one to be held liable for the breach of those particular contracts. So what the question was asking, and the rules which governs this particular contract. And I think we discussed on the legal provisions, which are the same with the rules. So number one, we said that this particular contract here, we said number one, they are null and void. They are null and void. Null and what? Null and void, and also unenforceable. They are null and void and unenforceable. Unenforceable. So basically what that means is that this particular contract here do not have any legal implication as far as the company is concerned. So if they are breached, the company cannot be sued, and equally the company cannot go to a court of law and basically take a legal action against the third party for the breach of those contracts. So they are null and void and also unenforceable. Number two, we say that the promoters are personally liable. Promoters are personally liable. Are personally liable for the breach of this contract, for the breach of this contract. So mean that if this particular contract are breached, automatically the company cannot be sued in a court of law. So the promoters are the one to be held personally liable for the breach of this contract. But equally in this case, recall, we talked about the various ways through which the promoters can avoid their personal liability. And actually, that is a very, very common question, whereby you can be required to explain various ways in terms of how the promoters, the founders of the company, can avoid being held personally liable for the breach of this particular contract. We talked about so many ways. Number one, we say that we can, or the promoters can enter into this contract in draft form. In draft form means that they will just negotiate those contracts on behalf of the company, but the contract will only be executed. The contract will only be performed once the company is registered. So they just negotiate the contract, but they will also agree with the third party that this is a contract we are negotiating on behalf of the company. The contract will only be executed, will only be performed once the company is registered. Number two, we say that the promoters can also avoid their personal liability by doing what? By basically including a clause in this particular contract that they can only be held liable up to the time the company is registered. Once the company has been registered with the registrar and the contract is breached, then they cannot be held personally liable. On the other hand, we say that the promoters can also do what? Can basically ensure that once the company is registered, the company enter into a new contract to substitute the pre-incorporation contract. So mean that once the company enter into a new contract with the same third party, the pre-incorporation contract between the promoters and the third party will be terminated and replaced by a new contract between the company and the same third party. And actually we say that is basically known as novation. That is known as what? Novation. So we talked about so many ways through which the promoters can actually be able to avoid their personal liability. And actually we said you need to understand, to remember those various ways through which the promoters can avoid their personal liability. Number three, the other rule which governs this particular contract, we say that the company cannot sue the third party. The company cannot sue the third party in case of the breach. In case of what? In case of the breach. So if the third party breaches this particular contract, the company cannot be able to go to a court of law, take a legal action against that particular third party. Number four, here we said that the company equally, or the third party, that is, the third party cannot sue the company, for the breach. The third party cannot sue the company for the breach. For the breach of what? For the breach of the contract. For the breach of what? Of the contract. So in case this particular contract is the breach, then you are saying that this particular third party cannot be able to do what? Cannot be able to sue the company for the breach of that particular contract. Number five, here we said that the company can do what? Can enter into a new contract. Can enter into a new contract. Contract to substitute. The pre-incorporation contract. The pre-incorporation contract through a process which is called what? Novation. Through a process called what? Novation. So the company, once registered, can enter into a new contract with the same third party, whereby the pre-incorporation contract would be terminated and basically replaced by a new contract between the company and the same third party. Also, on the other hand, we say that the members of the company cannot ratify. The members of the company cannot ratify this contract, cannot ratify this cannot ratify this contract. So the members of the company, maybe once the company is registered, cannot pass a resolution ratifying this contract. So to ratify the contract means that the members cannot pass a resolution to approve that. In case maybe the contract is breached, the company can be held liable. They can't do that. The members of the company cannot pass a resolution to do what? To ratify this particular contract. So therefore, those are basically some of the legal principles, or basically some of the rules which basically governs this particular contract here, which are known as the pre-incorporation contract. So let's move to the last part of that question, and we are told, describe the common law duties of the promoters. So the question here is asking about part C, common law duties of a promoter. Common law duties of who? Of a promoter. The common law duties of a promoter. Now, remember in this case, what we say is that during the formation of the company, basically we say that the promoters are expected to perform various duties. And actually we say that the duties of the promoters are basically broadly classified into two categories. Number one, we talked about the fiduciary duties. And number two, we talked about the common law duties. The common law duties. So therefore, the duties of the promoters are broadly classified into two. So the question here was asking about the common law duties. But before even we look on those common law duties, recall we said that the fiduciary duties, these are those particular duties which arises out of the fiduciary relationship which exists between the promoters and the promoters, and basically the promoters and the company to be formed. Remember, in this case, we said the promoters basically are regarded to be the trustees of the company. They are regarded to be the trustees of the company. So therefore, as a result of that fiduciary relationship, there are a number of duties which are expected from these promoters. Which are those duties? Number one, we talked about the duty to account. We say, if, for example, you're a promoter, you're given some amount of money to do a number of things on company's behalf, you must account. You must explain how you spent that particular amount of money, of which you say that accounting basically has to be honest. You must explain how you spent that particular amount of money, even necessarily support that with the necessary receipt. If you paid a number of items, you paid a number of expenses, support that with a relevant document. So then from there, we also talked about the duty of disclosure. In this case, we said that the promoters are expected basically to disclose two things. One is any secret profit. If you make a profit as a promoter, make sure you disclose that. Number two, the promoters are also expected to disclose any personal interest. If, for example, you have some personal interest in a transaction, in a contract you are entering into on company's behalf as a promoter, you need to disclose that to the other promoters. And finally, number three, we talked about the duty to act bona fide. The duty to act bona fide. We say as a promoter, anytime you are doing something on company's behalf, you must do it in the best interest of the company. You must do it in the best interest of what? Of the company, in the best interest of what? Of the company. So therefore, we talked about those three fiduciary duties, the duty to account, the duty of disclosure, and the duty to act what? Bona fide. So let's now look on these common law duties. The common law duties of promoters. The common law duties of the promoters. Common law duties of promoters. Common law duties of who? Of the promoters. Now, when we talk about the common law duties of the promoters, number one, we say that these are the general duties. The general duties of the promoters. So these are what? These are general duties. General duties of who? Of promoters. Of promoters during the formation of what? During the formation of the company. Formation of who? Of a company. During the formation of who? Of the company. So, and these duties, we said they include what? We said they include number one, basically to do what? To come up with the company's name. Come up with the company's what? Company's name. So it is basically the responsibility of the promoters to come up with a company's name and have it reserved. And have it reserved. And have it reserved. And have it what? Reserved. Now, the other duty of the promoters The other duties, the other duty of the promoters, or that is the other general duty. And I've said that these are general duties. These are general duties. So the other general duty of the promoter is basically to register the company, with the registrar of companies. So it is the responsibility of the promoters to do what? To register the company, with the registrar of companies, Number 3 is that the promoters here do have the responsibility to appoint the first directors of the company, to appoint first directors of the company. Number 4, we say that they have a responsibility to do what? To meet, or in other terms, to pay the preliminary expenses. Remember, in this case, we said preliminary expenses. These are those particular expenses which are incurred during the formation of the company. Who should pay those particular expenses? It is the founders of the company. That is the promoters. They have a responsibility to pay those particular expenses. On the other hand, we say they have a responsibility to acquire basically assets or property for use by the company. By who? By the company. So they have a responsibility to acquire property or asset for use by who? By the company. On the other hand, we say that if the company which is to be registered is a public company, the promoters do have a responsibility to prepare the prospectus. So we cannot talk about to prepare the prospectus. If the company registered is a public company. If the company to be registered is a public company, the promoters do have that responsibility, basically to do what? To prepare a prospectus. Remember, we say that a prospectus is basically that document, or basically an invitation by the company, inviting the members of the public to do what? To subscribe the shares of the company. The shares of what? Of the company. So that particular prospectus has to be prepared by who? Has to be prepared by the promoters. The promoters have a responsibility of preparing that work, of preparing that particular prospectus. So therefore, those are basically the general duties of who? Of the promoters. And I think that is it. That what was required as far as that question is concerned. That is the question number 5. So let's move to the other question, that is question number 6. In question number 6, part A, it reads, identify the different types of meetings that may be held by a public limited company 8 months. So in that case, we are required to identify, in other terms, to do what? To explain different types of meetings which may be held by a public limited company. Remember, you say that once a public limited company has been registered, has actually been formed, that company may convene, in other terms, may hold different types of meetings, different types of what? Different types of meetings. So question number 6, question number 6, part A, types of meetings that may be held, by who? By a public limited company. So types of meetings that may be held by a public limited company. So I think we talked about 5 types of meetings. 5 types of meetings. Yes, I think we talked about 5 types of meetings. Number 1, we talked about a meeting which is called AGM. The AGM, that is the annual general meeting. The annual general meeting. So remember, I said that the AGM, annual general meeting, this is a meeting which all the public limited companies are required to convene on annual basis. So mean that this meeting here is held on annual basis every year. that a public limited company has to convene this meeting. And actually, we said that private companies are not under any obligation to convene these meetings for their members, to hold these meetings for their members. Number two, we say that these particular meetings should be held before the end of 6 months in the following financial year. Meaning that if, for example, a company is to hold maybe an AGM for 2025, that meeting actually will be held the following financial year 2026, but equally before the end of June. So it is held before the end of the 6 months in the following financial year. And actually, we say that this particular meeting is for it to be convened. The members, we said, must be served with 21 days notice. On the other hand, we said those businesses which are transacted in this meeting, we refer to them as ordinary business. Business. And I think we were able to look on the various businesses which are transacted during the AGM. So those businesses include what? Number one, appointing the company's auditor. That is one of the ordinary business, appointing the company's auditor. Number two is electing the directors. Number three is basically a declaration of payment of dividends. The other one is what is the consideration and the adoption of the audited financial statements. And the other one is about what? Is about consideration and also confirmation of the minutes of the previous AGM. So therefore, we talked about those as the different types of businesses, ordinary businesses, which are basically transacted during what? During the AGM. The AGM. So the other type of meeting which may be held by this company is something called the EGM, extraordinary general meeting. So extraordinary general meeting, we say that this is any other meeting held other than AGM, and also what? The statutory meeting. And actually, we say that this particular meeting here is convened to transact what is called the special business. To transact the special business. When we talk about the special business, we are referring to those particular businesses which cannot be transacted during the AGM. During what? The AGM. And actually, we say that this particular meeting here can be convened either by who? By the court upon application. It can also be convened by the directors. Or it can also be convened by the requisitionist. Remember, in this case, I was able to explain who are the requisitionists. The requisitionists are basically those particular members of the company who had requested the directors to convene this meeting, because we talked about certain number of members who may request the directors of the company to convene this meeting. We say once the directors have been requested to do that, they must convene the meeting within 21 days. If they fail to do that, then those members who had requested the meeting to be held, who are now known as the requisitionists, they can go ahead and basically convene that particular meeting. So the other meeting, which can also be convened, in other terms, held by a public company, is something called a class meeting. A class meeting. And actually, we say the class meeting is a meeting of a certain class of who? Of shareholders. A certain class of who? Of shareholders. A certain class of shareholders. For example, in this case, we say that if the company has issued maybe the ordinary shares and also the preference shares, we said that the company can convene a general meeting of the ordinary shareholders, or the company can convene a general meeting of the preference shareholders. So that particular meeting is known as a class meeting. And actually, we say that that particular meeting is ordinarily held by the company to approve something called the variation of a class rate. Variation of the class of the class rate. When we talk about variation of the class rate, it basically means that this is a meeting which is convened by this company to do what? To approve some changes in relation to some rights affecting a certain class of shareholders. If, for example, maybe the company wants to, the directors are proposing the rate of dividend, the rate of preference dividends, maybe to be reduced from, assuming the company currently is paying 12%, the directors have proposed to reduce that rate of preference dividend, maybe from 12% to 10%. So that one has to be convened, or actually that company would be required to convene a general meeting, not a general meeting per se, but a class meeting of the preference shareholders, whereby the preference shareholders will come in and basically discuss that issue, approve it by a special resolution. So then from there, we also talked about the other meeting which may be held. Let's talk over the board meeting. Let's talk over the board meeting. The board meeting? After we say the board meeting, this is a meeting of the members of the board, is a meeting of the directors of the company. We say that this meeting may be convened anytime. There is no timeline when this meeting should be held. So it may be convened anytime, basically for the director to be able to do what? To transact a number of businesses during the board meeting. And I think also we talked about something called the statutory meeting. I hope you can be able to recall, we said statutory meeting, basically this under the new Companies Act, companies or public companies are not mandated. They do not have any responsibility to convene this meeting. But you said the new Companies Act states that any company which was formed under the repealed Companies Act, under the old Companies Act, it had not convened this particular meeting. You have to go ahead and convene that meeting. But we said under the new Companies Act, Companies Act of 2015, public companies are not under any obligation to do what? To hold that meeting. In other terms, any company which is registered in accordance with the Companies Act of 2015, that company do not have a responsibility to do what? To convene that meeting. So therefore, these are different types of meetings which may be convened. In other terms, which may be held by these public companies. So 8 months for that. So part B of the question reads, state the rule in Sharp versus Davis and explain the exceptions to the rule. The rule in Sharp versus Davis and the exemptions So this is a rule which we discussed in this topic of meetings, And actually we say that this particular rule here, the rule in Sharp versus Davis, basically states that a meeting of a company cannot be duly constituted if attended by one person, even if that person is attending the meeting in more than one capacity. We said you can attend a meeting in more than one capacity. This whereby you are attending a meeting as a member of the company, and also you are attending as a proxy. You are representing another member. Provided it's only one person who is present, that meeting shall be deemed not to be properly constituted. So the rule state that a meeting of a company constituted by one member, even if he or she is attending the meeting in more than one capacity. In more than one capacity. In more than one capacity. Even if that person is attending the meeting in more than one capacity. So attending the meeting in more than one capacity, that is attending the meeting as a member and also as a representative, as a proxy of another member. So that basically what this rule states. Then from there, we can give the exceptions to the rule. So first of all, what do you mean by the exceptions to the rule? The exceptions to the rule, basically, these are the circumstances whereby the meeting of a company can be duly constituted by one person. So only one person who attended the meeting, but the meeting shall be deemed to be properly constituted, and actually any resolution which is passed in such a meeting shall be deemed to be valid. So which are those circumstances? Which are those instances whereby the meeting of a company can be duly constituted by one person. Number one is what we call the creditors meetings. The creditors meeting during the company's liquidation. During the company's liquidation. Now, if you can be able to recall what we said in relation to the topic of company's liquidation, we said whenever a company is being liquidated, meetings of creditors must be convened. One of the main objective of these meetings of creditors is for the creditors to be able to prove their debts, because we say that if, for example, by the time the company is liquidated, you are claiming the company, you're claiming some amount of money from the company as a creditor. There is an amount of money you have not been paid by that company. You have to prove which goods did you supply to that company. Do you have a supporting document? Which services did you provide to the company? Do you have a supporting document? You have to prove that. So therefore, we said there should be a number of creditors meetings. And now, in this case, we said if a company has got a single creditor, then that is the person who is entitled to do what? To attend those particular meetings and do what? And actually to attend those meetings. So therefore, during the company's liquidation, the meeting of creditors can be constituted. A creditors meeting can be constituted by one person where the company has got a single creditor. So number two, we talked about the board meeting. The board meeting of a private company. The board meeting of a private company. Board meeting of a private company. So in this case, we said private companies here are required to have a single director. And therefore, if a private company has got a single director, one director, that is the only person who is entitled to attend the board meeting. And that board meeting, even though attended by one person, the meeting shall be deemed to be properly constituted. Number three, we talked about what we call as the adjourned meeting. Adjourned meeting. So when we talk about adjourned meeting, this is a continuation of a meeting which was postponed due to lack of quorum. Remember, I said that if, for example, a company has convened maybe a general meeting of members, and the meeting do not have a quorum within 1 hour of the appointed time, within 1 hour from the time the meeting was supposed to start, then we say that the meeting will have to be called off. In other terms, the meeting will have to be postponed, or in other terms, it will have to be adjourned. It will have to be discontinued. We said the company should convene, or another meeting will be held next week, the same place, the same time, unless resolved otherwise by who? By the directors. And actually, all the members would be notified that the meeting didn't take place because there was no quorum, and therefore they are expected to attend the following week. So if coming next week, still one member attend, that meeting shall be deemed to be duly constituted, and actually the meeting shall proceed and transact those businesses which were supposed to be transacted by the members. So adjourned meeting. So then we have number four. We have what is called a meeting convened by the registrar of companies. So the registrar of companies can issue an order requiring a company to hold a certain meeting, and equally in this case, the registrar will still order that even if a single person attend, the meeting basically go ahead and basically transact those particular businesses which the registrar of the companies which the registrar has actually ordered to be transacted in such a meeting. So number 5, we have a meeting convened by a court order. So these are those particular meetings which are convened as a result of an order issued by the court. So in this case, the registrar will equally do what? Will equally not the registrar, rather the court will actually may order as a meeting to be convened, and still order that even if that meeting is convened is attended by one person, the meeting should go ahead and transact those businesses which the court has ordered to be what? To be transacted. To be what? To be transacted. To be what? To be transacted. To be what? transacted. Yes, automatically this one should be the high court. This one should be the high court. This one should be what? This one should be the high court. Yes, I think we can talk over those 5 exemptions, but also remember we have others. We have other what? Other exemptions. We also have other exemptions. So I think maybe we can just talk over the 5. We can talk of the 5, but remember we also have others. Yes. So let's go to the last part of the question, whereby we are required to define what is a special notice. What is a special notice? What is a special notice? Special notice. Special notice. Now, we say that special notice, basically, this is a notice which must be given to the company by its members 28 days before. So the number of days is very important. 28 days before a certain meeting. For example, in this case, we say if the members of the company intend to remove the director or one of the director in the forthcoming AGM and maybe replace him with another director, they want to remove the auditor and replace him, the returning auditor, replace him with another auditor. So they must give the company a special notice. So therefore, this is a notice given to the company by members 28 days before the day of the meeting, 28 days before the meeting, before the meeting, informing the company about the intention to pass a certain resolution. So this is a notice which is given by the members 28 days before, that is given to the company by the members 28 days before the meeting or before the date of the meeting, informing the company about the intention to pass certain a resolution. Equally, we can say that this notice is required for what? Or when should this notice be given to the company? When should this notice be given to the company? Number 1 is when the members of the company intend to pass a resolution to do what? To reappoint a director who has attained the retirement age. So this notice is required for a resolution to do what? To reappoint a director. Who has attained the retirement age. The retirement age. And who can be able to report? We said a director should retire after attaining the age of how many years? A director should retire after attaining the age of how many years? A director should retire after attaining the age of 70 years. The age of 70 years. So we said, assuming a director has attained the age of 70 years, maybe in April here, and maybe our company will be holding its AGM in June. So basically, we said this particular director here, who has already attained the retirement age, is not supposed to retire in April, but rather this director is supposed to notify the company that he has already attained the age of the retirement age of 70 years, and that director is supposed to retire in the forthcoming AGM. AGM. So automatically, in the notice which will be sent to the members about this AGM, the members will be notified that one of the directors has attained the retirement age, and therefore he will be retiring in the forthcoming AGM. But in this case, the members of such a company may be happy with the services or with how that director has served the company, and they wish to reappoint him back despite having attained the age of 70 years. So we said for the members to do that, they must give the company a special notice. They must notify the company 28 days before that AGM that they want to reappoint that director back in the office despite having attained the age of 70 years. That's why we are saying that this notice is required, number one, for a resolution to reappoint a director who has already attained the age of 70 years. Number two, this notice is also required for a resolution to remove the auditor from office, to remove the auditor. Number three is also required for a resolution to remove the director. To remove who? The director. To remove the director. So therefore, this particular notice here is required for those resolutions. Is required for those what? Is required for those resolutions. Yes. So that is it. That basically what is required as far as those questions are concerned. Those questions are concerned. So what I want us to do is maybe just take a short break of 10 minutes, and then we come back. I want us to look on this other paper. That other paper. I've reshared the paper in the class WhatsApp group. So we come back and basically look on some of the questions from that paper. Yes, so we take a short break of 10 minutes. We come back at 1:15.
check whether starter class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this, it may be, if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction and we have this direction. So this is to say, You can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why they are saying compounding techniques. compounding techniques. So we start with the compounding techniques number 1. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal: 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus R power n. Principal times 1 plus R power n. And this is what we call present value. Present value. This principal figure here is what we call present value. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of an annual, future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future, but no. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus R power n. This factor here, this factor 1 plus R power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus R into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return, rate of return, of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annual. Determine the future value of the investment after 3 years. N, we should have said N here, N. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000. That is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount amount with, let's say, 100,000. No, will that give us? No. No, that is the only way. Okay, the other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus r power n minus 1 over r. That's how we get the future value of an annuity. 1 plus r, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus r into brackets power n minus 1 over r. This factor here, the factor 1 plus r power n minus 1 over r is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return, or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. We have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer, get the answer. Three 322,080. Another person. 322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period, 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 16. 16. 16. 16. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000. and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call, okay, fine, Alice, 080, okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that you invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. One plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they're saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus r power n minus 1 over r times 1 plus r. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. And 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, 144, 93, 144, 93, 125 for 40, 125 for 40, and 112,000. So get the sum. $711, $519. $711, $519. Now, the reason why we are doing these two methods, this is very short. This is like a shortcut. But we are doing this method so that you can get the concept. Because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting it is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting. Or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum still the same thing as we've said. An amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus R power negative n. So look at this factor now. Look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative n. So where this is future value, R we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative n, the factor 1 plus R power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R percent power n. Present value interest factor, R% power n. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check on WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting. I have shared. Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Okay, but that one we're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equal to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000. 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor R% power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we're together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there at 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what you're supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value No, yeah, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r% power n. Present value interest factor of an annuity r% power n. Thus, present value of an annuity is equals to the annuity times present value interest factor annuity r% power n. R% power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember this formula here, this formula that you're seeing here, this one.
Company Perry Limited leased an item of machine from a supplier. So automatically, Perry Limited is the lessee, is the company which was given the right to use an asset, whereas now the supplier is the owner of the asset. So if you go to the requirement, you're required to analyze the accounting treatment of the above this transaction in the financial statements of who? Of Perry. So in other terms, you're required to illustrate how Perry Limited, who is the lessee, was supposed to account for this particular risk. And remember what we said is that once a company leases an asset, so that company should recognize two items: the lease liability, the right of use asset. But remember, we also talked about two exceptions in relation to that. You may come across that theory question whereby you are asked to give two circumstances, two instances whereby the lessee will not be required to recognize the lease liability, and also the right of use what? Asset. So we talked about two circumstances. Number one, we talked about a short-term lease. If you lease an asset for a short period of time, a period which is less than 1 year, you are not required to recognize the lease liability and the right of use asset. Number one is therefore where the lease is a short-term lease. Number two is whereby the lease asset is of a low value. If you lease an asset which is regarded to be of a low value, you are not required to recognize the lease liability and the right of use what? Asset. But this company, Perry Limited, basically on the date the lease commenced, the company needed to recognize two items, the lease liability and the right of use what? Asset. We said always we start by computing the lease liability. We start by computing the lease liability, and basically we compute this on the date when the lease commenced. In other terms, we compute this on the inception date of the lease. So if you go back to the information we have in the first paragraph, the first sentence, this lease was entered into on 1st of December 2020. That is when this company, Perry Limited, leased that particular item of machine. So we need to compute the lease liability. How do we compute this lease liability? We say that this one is equal to the present value of the minimum lease rentals not paid at the inception date. Not paid at the inception date of the lease. Inception date of the lease. Not paid at the inception date of the lease. So we discount those particular minimum lease rentals, but which were not paid at the inception date. So basically, if we go back to the information still which we have in paragraph 1, we are told that this company leased an item of machine for a period of how many years? For a period of how many years? Are we given? Yes, for a period of 4 years. I hope you can see that in the first sentence. So this therefore is the lease for how many years? Is the lease for 4 years. Year 1, year 2, year 3, year what? Year 4. So how are the minimum lease rentals payable? As per the information we have in sentence number 2, we are told the terms of the lease were that Perry Limited was required to pay annual lease rentals or annual rentals of 1.55 million in arrears. In arrears means what? At the start or basically at the start or at the end of the year. Who can tell us? In arrears means what? At the start or at the end? At the start or basically at the end? Yes. In arrears means at the end. So this amount was payable at the end. So the amount which was supposed to be paid at the end of year 1 is 1.55 million, 1.55 million. At the end of year 2, at the end of year 3, 1.55 million, 1.55 million. And therefore, if you check this particular question which you are doing here, you should be able to note that it is different from the other question which we did. I hope you can remember the other question which we did in class the other day, a question which was examined in December 2024. So remember the lease rentals, the minimum lease rentals were payable at the start. So therefore, I want you to see the difference. Rin, I think there was a question which was asked by Rin. There was a question which was asked by Evans. So in terms of the difference, whenever the minimum lease rentals is payable at the start and also at the end, we say there is a difference in terms of how we compute the lease liability. Number 2, how we prepare the lease amortization schedule. Remember, therefore, all these particular amounts are payable at the end. So how do we compute the lease liability? We discount the minimum lease rentals not paid at the inception date. Now, this amount, all of them, you can see they were not paid at the inception date because there is no amount which was paid there. Because we said we discount everything excluding the amount paid at the inception date. So we will take 1.55 million. We multiply this with the present value interest factor of annuity at which rate? At the rate of 13%. At the rate of 13%. The rate of 13%. Then what will be our N here? Our N will be 1, 2, 3, 4. So we are discounting minimum lease rentals for how many years? For 4 years. That's that? Yes. So for 4 years. But remember, if this particular amount were payable in advance, so for example, this amount was paid here at the start of year 1. This was paid at the start of year 2. This was paid at the start of year 3. And this one was paid at the start of year 4. What would be the difference? The difference would be our N here. Our N should be 3. Our N should be 3 because we just need to discount what was paid there, and there. So the amount paid at the inception date should not be discounted. Sasa? Yes. So let's work out this. And I think in our case, we already have this value. We already have this value. Remember, we said, in case the examiner has not given you this is the formula you have to recall. 1 minus 1 plus r raised to power negative n, we divide that with r. So that is the formula you need to remember. But I think in our case, we already have this value here. In the last paragraph, you told the present value interest factor of annuity at 13% for 4 years. This one is given as what? This one is given as 2.97447. So if you work out this using this particular formula, you have 1 minus 1 plus r. Remember, our r is 13% raised to power negative n, that is 4. And then you divide that with 0.13. You should get that value there. You should get that value there. Yes, we multiply that with 15, 50. So what would be our risk liability here? What would be our risk liability? What would be our risk liability? We try to hurry up so that we do at least more questions. What are you getting? So I'm getting a value of 4610. 428.5. Yes, so basically that is the value I'm getting. Yes, I think we can work with that figure right now. Yes, so that basically would be the risk liability. Now we said, even before we move to compute the right of use asset, what do we need to do with this risk liability? We need to amortize it. Before we proceed to compute the right of use asset, can we amortize this? So let's amortize this by basically preparing the risk amortization schedule. There is amortization schedule. There is amortization schedule. So you'll also be able to see that there is difference in terms of how we're going to prepare this with what we did in the other question, simply because these minimum risk rentals are payable at the end. So take into account our risk is basically for 4 years. We need to have 4 years here, or you can have the specific date when those 4 years were ending. So those specific dates are given in the requirement. If you go to the requirement, so you'll be able to see that you're given those specific dates. The first year ended 30th of November, 2021, 30th of November, 2022, 30th of November, 2023, and 30th of November, 2024. So then the next column here should be for the risk liability at the start of the year. The next column will actually be for the interest. The next column will be for the interest, and this one we computed at the rate of 13%. But remember, if these minimum risk rentals were payable in advance, so after the risk liability, the next column should be forward for the cash paid, for the minimum risk rentals paid, if this one was payable at the start. Yes, but because it is payable at the end, so the next column should be for the interest. The next column should be for the minimum risk rentals, paid. And finally, we have the risk liability at the end of the year. So that's basically how we arrange our risk, the risk amortization schedule. And therefore, you can see always we interchange these two columns, depending with when the minimum risk rentals is payable. Can you be able to see that difference with what we are doing here and the other question which we did in class? Rin, can you be able to see the difference? Evans, can you be able to see the difference? Yes, I want you to see that difference. There is always a difference in terms of how we compute this one. There is the risk liability, and actually how we do what we present this. So in case the minimum risk rentals is payable at the end, so after the risk liability at the start, what comes next is the interest, and then the minimum risk liability. Yes. So what we start with here is basically the risk liability at the start of year one, and that is basically what we have computed there, which is basically an amount of 4610 for 28.5. So we compute interest, which will be 13% of this, 13% of the opening balance, 13% of this, and basically I'm getting 599, 356 to the nearest whole number. Let's work with that to the nearest whole number. And then the minimum risk rentals, which was paid at the end of year one, is this one, 1550,000. So this one we said it reduces the value of the liability. So to compute the risk liability at the end of year one, we will take this one, risk liability at the start of year one, we add the interest, we minus this. So in other terms, to compute this, we are taking what? In other terms, to compute the risk liability at the end, we are taking this one, the risk liability at the start, we are adding this one, the interest paid, we are raising the minimum risk rental paid. So we are taking A plus B minus what? Minus C. Minus what? Minus C. That's basically how we are getting that value there. Sasa? Yes. So let's work out that. So we add 46, 10, 428.5 minus 1550. Yes. And basically here I'm getting what? I'm getting 36, 59, 784, 784.5, or let's just work with this to the nearest whole number. Let's just work with that to the nearest whole number. 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 This one should be 9. Eh? Let's work with that. It's 9. To the nearest whole number should be that. Eh? Yes. So that will be the opening balance here. 3659. 3659, 785. So we compute interest, which is the 13%. 13%. Basically, I'm getting 475. 772. So the amount which was paid at the end of year 2 is this one, which is 1550,000. And then we compute the risk liability at the end of year 2. So we have 36, 59, 785 plus the interest for 75, 772 minus 1550. Yes. And what are you getting here? My figure automatically is not correct here. Yes, what are you getting? Yes, 25, 85, 557. Eh? Yes, so that will be the opening balance here. 25, 85, 557. So we compute the interest as 13%, which will give us 336, 122. The amount paid is 1550,000. Yes. So let's work out the risk liability at the end of the year 3. We have 25, 85, 557 minus 155. Yes, and basically here I'm getting 13, 71, 679. 679. I hope that is what you're getting. So that will be the opening balance here. Is the opening balance there. And then we compute the interest as 13%. 13%, and basically I'm getting 178,318. So the amount paid there is 1550,000. And automatically this one should give a 0 or a figure which is insignificant. So let's see what we have. 178,318. Yes, 1371, 679 plus 178,318. Yes, so I hope you can see this coming for around 3, but essentially should be 0. Should be 0. The reason why you're not getting 0 is because of rounding off. So therefore, that's basically how we prepare that particular risk amortization schedule, basically to amortize our risk liability. Having this 10, we need to move and basically we compute the right of use asset. The right of use assets. And basically the right of use asset, equally we compute this at the inception date of the risk. Remember, the risk commenced on 1st of, this one should be December. It should be December. 1st December of 2020. That is when we are computing the right of use asset. Now to compute the right of use asset, we said we add like three values. Number one, we take the risk liability. The risk liability at the inception date. And basically that is the inception date is 1st December 2020. So, and the risk liability at the inception date is what you have computed here. 4610, 429. To this we said we add any payment made payment made at the inception date, at the inception date of the lease. Do we have any payment which was made here at the inception date of the lease? In our case, we don't have any payment which was made at the inception date. We say that you can only have that payment which was made at the inception date, whereby these minimum lease rentals are payable in advance. So if it is payable in advance, automatically the amount was supposed to be paid at the start, at the inception date of the lease. And then to this we add what? Initial direct costs, which are associated with what? With the lease. The initial direct costs associated with the lease. And I think in this question here, we have some initial direct costs which are associated with the lease. Can you see that? Initial direct costs associated with the lease. Who can be able to see that value? It is within paragraph 1, the last sentence. Can you be able to see this? Abdinasil? Amos, can you be able to see that? Yes. Yes. So the initial direct cost associated with the lease is 570. So we add those two values and we get now something called the right of use asset. The right of use asset. So the right of use asset will be 4610, 429 plus 429, 570. And basically we get what here? We get 15. Okay, I think we can work with this one as 0.85, though you can't be penalized for that. So that will give us 50, 39, 998.5. Is that what you're getting? Is that what you're getting? 50, 39, 998.5. Yes. So having that, then the next thing we need to do is basically to compute the depreciation per annum. Remember, we say that this right of use asset should be depreciated on a straight-line basis at the shorter of two periods. At the shorter of two periods, number one, the lease term. The lease term basically is the period of the lease. In our case, we know this is the lease for 4 years. And number two, the remaining useful life of the asset, or the remaining economic life of the asset. So we're given that in paragraph 2, we are told the machine had a remaining useful life of 6 years. 6 years. So out of the two period, we take the shorter of the, or actually we take the period which is shorter, which is basically 4 years. So we will depreciate this on straight-line basis for 4 years. So to compute the depreciation per annum, we will take the right of use asset 50, 39,998.5. We divide that with 4. We divide that with what? We divide that with 4. So we have 50, 39,998.5 divided by 4. And basically this will give us depreciation of 12,559. 1259. So the nearest whole number, I think should be 1260. Is it 1260? Yes, 1256,000. To the nearest whole number. To the nearest what? To the nearest whole number. To the nearest whole number. Yes. Now, that basically what was required. But if you check on what the question is requiring, we require to analyze the accounting treatment of this in the financial statement. We said, in such a case, what you need to do is you prepare financial statement extract. You prepare the income statement extract. You show what was supposed to be recognized there in relation to this risk. So we start by preparing the income statement extract. And remember, you say that in the income statement extract, what the company is supposed to recognize, 2 items. One, we have these interest, and actually we say that this interest should be recognized as part of the finance cost. Number 2, the company should recognize this particular depreciation. So, and actually we are going to prepare this for these 4 years here. The first year ended that year's November 2021, that year's November 2022, that year's November 2023, that year's November 2024, like that. 4 years. So at the expenses, our company will recognize 2 items. At the expenses, so we have these interest. You can just refer to it as interest, or you can just included here as part of the finance cost, because that will be a finance cost. So this will be the interest for the first year, 599, 356. So for year 2 is this one, 475, 772. For year 3 is 336, 122. And basically this one is 178, 312, 318. Yes, the other item which will also be recognized here is basically the depreciation on the right of use asset. The depreciation on the right of use asset, whatever you have here, this one. And basically this one remain the same for 4 years. 1256,000, 1256,000 fair, 1256,000 fair. Yes, so that is basically what our company here was supposed to recognize in the income statement as far as this is what is concerned. So these are basically the values which will be marked. Remember, we have said whatever, or actually we said whatever you have done here, all these are workings. What earned you the marks is what you have here. Sasa? Yes. So therefore, you must ensure that you have prepared these financial statements extracts. So then from there, we can prepare the statement of financial position, statement of financial position extract. Statement of financial position extract. 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 Equally, we will prepare these basically for 4 years. That year, the November 2021. That year, the November 2022. That year, the November 2023. That year, the November 2024. 2024, like that. Now, here in the statement of financial position, how many items will be recognized here? 3 items. One of it, David, automatically the figure which you have in the 1250. Oh, that will give us 1260. The 1260, yeah? So the nearest whole number, David. It's up 1260. Is that in the position? Yes, I think this one should be 1260. Huh? It should be 1260. Like that. I think that should be the correct value. Is that the case? 1260? Yes, 1260. I think it is our rounding off, which is basically along here. But basically should be 1260. 1260, yeah? Yes, 1260 like that. Yes. So basically 3 items to be recognized here. One of which is the right of use asset. Now the right of use asset, that one we recognize it as part of the non-current assets. So under the non-current assets, we will have the right of use assets. The right of use asset. Now, the right of use asset, we recognize it here at the net book value. So, to compute the net book value for the right of use asset, we will take the cost, this one, and then we less depreciation for year 1. When it comes to year 2, we take this one minus depreciation for how many years? For year 2. Forward for year 2. No, you don't need to show that as provided you have recorded that as expenses. The person who is marking that will be in a position to see that those are expenses, provided they are at the expenses, because these are an extract. That's an extract. Yes, let's compute the right of use asset, the net book value. So we take the cost, which is 39,998.5, and then we minus the depreciation for the first year. This is the depreciation for the first year, which is 1260 x part 4. And basically that will give us what? Will give us will give us 37, 79, 99. Okay, so the nearest number, it will give us something like that. So then year 2, we also do the same. In year 2, you can take this minus that depreciation. Are we together? Yes. So we take, alternatively, you take this minus depreciation for 2 years. But the easy approach is once you have computed the net book value for year 1, to get the net book value for year 2, you take the net book value at the end of year 2, at the end of year 1, sorry, you less the depreciation for year 2. Sasa? Yes, so we will take this, we less depreciation for year 2, which is 1260 x part 4. And basically that will give us 25,19,999. What about there? So we take that value, we less depreciation for year 3, which is 1260. And that will give us 1260,000. And then here, the net book value will automatically be 0 because it is this minus that. So that's how we compute the value for the right of use asset. Then from there, we said that this particular lease liability, this one should be recognized in the statement of financial position as a liability. But basically, we said this amount has to be split into two. Part of it will be recognized here as an non-current liability. So under the non-current liability, we will have the lease liability, and still under the current liability, under the current liabilities, we will also have what? The lease liability. We will also have the lease liability. I think I showed you how to split that, how to determine the amount to be recognized under the non-current and also under the current. We said, I think, whatever is very simple is first of all to determine the amount to be recognized under the non-current liabilities there. Under the non-current liabilities there. So we said the amount to be recognized as an non-current liability at the end of year 1, that is this year, we take the lease liability at the end of year 2. So the amount to be recognized as a non-current liability in year 2, we take the lease liability at the end of year 3. At the end of year 3, we take the lease liability at the end of year 4. At the end of year 4, the lease liability at the end of year 5. So therefore, in year 1, the first year here, the amount to be recognized as an non-current liability is this one. So which is 25,85,557. In year 2 is what we have here, 13,71,679. In year 3 is basically 0, and also in year 4 is 0, like that. Yes. Then from there, to determine the amount to be recognized as a current liability, we say this amount payable within 1 year, and therefore we said we take the decrease, because the decrease basically is the amount which has been paid. The reason why liability reduces is because there was a payment which was made. There was a payment which was made. So let's get the difference here between these two values here. We have 36, 59, 785 minus 25, 85, 557. And basically we have a decrease of 10, 74, 228. I hope that is what you're getting. David, the writer, is that what you're getting as the decrease, as the difference between those two values? Is that what you're getting? Yes. So then we move to year 2. Year 2, basically we get the difference between these two values here. The difference between those two values there. That is the 25, 85, 557, 25, 85, 557, and this one, minus 13, 71, 679. So basically that will give us an amount of 12, 13, 878. Yes. And then now in year 3, we get the difference between this. Remember, the lease liability there is 0. So the difference between those two values there is what? Is 13, 71, 679. And automatically in the last year, the lease liability is what? Is 0. And the lease liability there is 0. The lease liability there is what? Is 0. Is what? Is 0. So that is it. That what was required in that question. So what will earn you the 8 marks is basically what we have here. But remember, there is a similar question which we did in your paper 6. That question, the marks allocated there were 10. So meaning that in such a question, you can either be given 8 marks or basically 10 marks. But what I want you to understand is the difference in terms of how we compute the lease liability, how we compute the right of use asset, how we prepare this particular lease amortization schedule whenever the minimum lease rentals are payable at the start of the year and also at the end, because that is the question we are likely to come across. The minimum lease rentals are payable either in advance or in arrears. You must be in a position to compute the lease liability to prepare this one and the right of use asset. Yes. So basically that is it. That what was required as far as that question is concerned. And therefore, I hope that if you happen to come across a question from this topic, the topic of leases, I expect you to score good marks as far as that question is concerned, because I think we have revised from this. Maybe what you also need to do is, can you try to check on how the leases are accounted for by the owner of the asset. The owner of the asset, or basically the lessor. Try to remind yourself how that particular person accounts for the leases. Account for the leases. Account for what? For the leases. Account for what? For the leases. Okay. So we have that. We have another small question here. Basically, I want us we switch now to another topic, a topic of financial instruments. So remember, in relation to that topic of financial instrument, we did a number of we covered a number of concepts. The first concept we did was on compound financial instruments. Compound financial instrument. And remember, I say that compound financial instruments are the financial instruments issued by the company. They contain both equity and liability component. And actually, we say once the company has issued a compound financial instrument, as per the requirement of or as per IS 32, the company should split the two components. The company should split the liability component and the equity component. There is this equally a question here I want us we go through. Let me share the same. But there is a similar question which we did in class, which is the same with this. Yes, equally I've shared that question in the class WhatsApp group. I've shared that question in the class WhatsApp group. I hope it is clear. I hope it is clear. Is it clear? Whatever I've shared in the class WhatsApp group. Is that question clear? Yes, I hope it is. I hope it is. I hope it is. But before we look on that, can we just take a short break of just like 8 minutes? We come back at 9:10, so that we continue with that question. So we just take a short break of 8 minutes, and then we come back up after that short break of 8 minutes. We come back at 9:10. Yes, so I want us to continue. I hope you're back. I hope you're back. So let's look on these that questions here. Let's look on that particular questions here. So the question reads, that Good Limited issued shilling 4 million 7% convertible bonds on 1st January 2019 par value. So the bond is redeemable at par on 31st of December 2023, or can be converted at that date on the basis of 2 shillings 1 ordinary share for shillings 10 of the bond held. So we are told the prevailing market rate on 1st January 2019 for similar bonds without conversion rights was 9% per annum. And then you're told that all the interest in the year to 31st of December 2019 has been paid. So what are we required to do here? We are required to calculate the amount being included in the statement of financial position of Good Limited in respect of the convertible bonds on 31st of December 2019. So now we say that if you happen to come across this question and you see the word convertible, if, for example, you're told a company issued a debt instrument, and that debt instrument issued by the company happens to be convertible, then we say what you need to remember very fast is that this is a compound financial instrument. This is a compound financial instrument. Remember, I said a compound financial instrument. We said that this is a hybrid financial instrument. In fact, in other terms, it can be referred as a hybrid financial instrument. It's a financial instrument which contains both equity component and the liability components. Contain the equity and the liability component. And we say once the company has issued such a compound financial instrument, as per IS 32, the company needs to split the two components, the liability component and the equity component. We look from the steps to be followed. First of all, we said we compute the liability component Number 2, we compute the liability what? A component. So what I want us to do, let's go straight to that question. We go straight to that question. Equally, this is a question I've borrowed from the paper for CIFA, financial statement analysis. So this, I think, was from which sitting of CIFA? This one from the sitting of November 2020. And this specifically was question number 5A. Question 5A. So we are told this company, which is called Good Limited, our company did what? Issued. The company issued 7% convertible bonds. So take into account, we have the word convertible. Convertible, I'll say that this one is a compound financial instrument. Yes. So therefore, that is very important. That if you happen to come across maybe a question and you're told a company issued some debt instruments and which are convertible, like convertible bonds, convertible loan stock, convertible debentures, you need to remember that that is a compound financial instrument. So therefore, this we can say this is a compound financial instrument and they should be accounted for. Should be accounted for in accordance with what? In accordance with International Accounting Standard number 32. Remember, I said this standard, International Accounting Standard number 32, basically requires that once a company has issued a compound financial instrument, the company should split the two components, the liability component and the equity component. So the first thing we do is to compute the liability component, and then from there we proceed and we compute the liability component. So therefore, step 1 is basically to compute the liability component, component. And actually, we compute this liability component on the date of the issue. When were these convertible bonds issued? We are told in the first paragraph they were issued on 1st of January 2019. 1st January 2019. 1st January 2019. So we say that this liability component is equal to the present value of the annual interest, the present value of the annual interest plus the present value of the principal payment. And actually, you cover similar concept in FM. For example, like when computing the value of debentures, the value of the other debt instrument. Usually, this is a concept you use. You discount the interest to be paid on annual basis and also the principal amount. These basically no much difference with what you do in financial management. Whenever you're required to compute the value of maybe a debenture, the value of a bond, I think it's basically what you do. So what we need to do here is first of all, we compute this one, the annual interest. So we say the annual interest, in other terms, the interest per annum. How do we compute this? We say the formula is very important because we say that in these questions, you'll be given 2 rates. You'll be given 2 interest rates. Which interest rate do we use? We use this one, the coupon interest rate. The coupon interest rate, we say, is the interest name coming before the name of the compound financial instrument. Like the compound interest rate is 7%, and then you multiply that with the par, the face, or in other terms, the nominal value of what? Of the compound financial instrument. So therefore, in our case here, the coupon interest rate, I've said is the interest rate which is given before the name of our CFI, which is 7%. And then still in the first paragraph, the first sentence, we're told the Good Limited issued shillings 4 million, 7% convertible bonds on 1st January 2019 par value. So meaning that 4 million is the par value. 4 million is the par value. Remember, this par value can also be known as the face value, can also be known as the nominal value. The examiner may use any of the words here. Yes. So this will give us shillings 280 million. And remember, this will be paid per annum. This one will be paid per annum. So we already have this. So then from there, we need to determine the principal amount. In this case, we say the principal amount. This is the amount payable on redemption. So once these particular convertible bonds mature, how much amount will be paid on redemption? So that information, we have it within first paragraph, the second sentence. We are told the bond is redeemable at par. That is very clear. The amount to be paid on redemption, this one is equal to the par value. So in our case, remember, we know the par value is how much? Is 4 million. So this is the amount to be paid on redemption, and we must be given the date when they will be maturing. So these convertible bonds, they have a life of how many years? So we are told they will be redeemed at par on 31st of December 2023. So that is the redemption date, and basically that will help us in terms of knowing the life of these convertible bonds. Remember, they were issued on this date. 1st January 2019, we are told they will be redeemed on 31st of December 2023. How many years do we have here between those two dates, between the dates they were issued and the redemption date? How many years do we have there? How many years do we have there? We have the first year, which will end 2019, and 31st of December 2019, 2020, 2021, 2022, 2023. 1, 2, 3, 4, 5. Yes. 2019, 2020, 2021, 2022, 2023. Are those 5 years or 4? They were issued on 1st January 2019. Are they 4 or 5 years? Remember, in this case, the year is supposed to end on 31st of December. Kuna 2019, 2020, 2021, 2022, 2023. Those are 5 years. So the life of these both in 5 years. And remember, in this case, we said when computing this liability component, we assume that the holders will not convert them into ordinary shares. I think we say that is an assumption which we make. That's why you check on that question. There is somewhere we're given information about how they can be converted into ordinary shares. There is no way we use that information here, because we say for us to be able to compute the liability component, we assume they will not be converted into ordinary shares. That's why that information about the conversion, we don't use it here. So we say to discount this, there are two approaches you can use. Remember, this company here, which issued these bonds, which have a life of 5 years, the life of 5 years, our company is expected to pay this amount per annum. To 𝐻 will be paid at the end of each year, and automatically this interest is always payable in arrears. This one is payable in arrears. That is the amount to be paid per annum. That is an annuity. And then at the end of year 5 here, the company will also pay this amount of 4 million. So we said to discount, you can either prepare, for example, a table here from year 1 all the way to year 5, and then you have this amount to be paid. Here you have to 80,000, year 2 to 80, year 3 to 80, year 4 to 80, but year 5, we will have to 80,000 plus 4 million. And then you discount this by multiplying that with the present value, interest factor. And which rate do we use in discounting? When discounting, do we use this 7%? No. In discounting, we say we use another rate, which is known as the effective interest rate or the market interest rate. And I hope you can see that within the last paragraph. We are given the prevailing market interest rate of 9%. So at the rate of 9%, you get those values, you multiply this with this, you get the present values. Alternatively, we said, because this is the 280 is an annuity, so to discount that to 80, we will take 280. We multiply that with the present value interest factor of annuity at the rate of 9%, and basically for 5 years. For 5 years, then this 4 million, these are lump sum which will be paid basically at the end of year 5. So we multiply that with the present value interest factor at the rate of 9%, and basically for 5 years. Remember the formula for getting PVIVA, and this one is different. So here we have 280. So the formula for getting this is what? 1 minus 1 plus R, which is 1.09 raised to power negative 5. We divide that with R 0.09. That is how we compute that PVIVA. And then we add this 4 million. So the formula for getting this is 1 plus R, which is 1.09 raised to power negative 5 by such. Sasa, yes. So let's work out this. We start with what we have here, the PVIVA. So we have 1.09 raised to power negative 5. So 1 minus answer divided by 0.09. That will give us 3.89. Okay, we can, I think we multiply that directly with 2.28,000. And this will give us 1089 102 102. That is basically what I'm getting here. What about this one? 1.09 raised to power negative 5. Is that correct? Can you confirm whether you get that? Yes, so raised to power negative 5 times 4 million. And basically that will give us 25, 99, 726. 726. Yes, so we add the two values. And I'm getting a value here of 36, 88, 820, 828. That is basically the value I'm getting here. You can confirm whether you're getting the same. Confirm whether you're getting the same. Are you getting the same? Yes, are you getting the same? Are you getting the same? Yes. So that is the what? That is basically the liability component. The liability component. The liability component. Now, having computed that liability component, step number 2 is to compute something called the equity component. The equity component. And actually, we also compute the equity component on the same date, 1st January of 2019. How do we compute this equity component? We take the cash proceeds. The cash proceeds. Cash proceeds, remember, we say that is the amount of money which was received. Once the company issued these particular convertible bonds, how much amount did our company receive? That information, we have it within paragraph 1. We told the company Good Limited issued shillings 4 million, 7% bonds at par. They were issued at par. The par value is 4 million. The par value is 4 million. So the amount which was received by our company was 4 million because we are told they were issued at par. They were issued at par. So we take that, and then to this we less what? We less the liability component. The liability component on the same date, 1st of January 2019. And that is now what you have computed here. This value here, 36, 88, 828. 828. So the difference here will be what? The difference here will be the equity component. Equity component on 1st January 2019. So, and that will give us 311, 172, 311, 172, 311, 172, 311, 172. So that is basically how we split. We split the equity component and the liability component. Sasa, yes. So if you happen to come across this question and you see the word convertible somewhere, it can either be convertible bonds, it can either be convertible debentures, it can either be convertible on stock. So what is important for you to do, to remember, is that that is a compound financial instrument. Being a compound financial instrument, you need to split the two components, the liability component, the equity component. After doing that, we say that the value for this equity component for the next 5 years remain, the value for this equity component for the next 5 years will remain the same. We remain the same. But basically this one, whatever you have computed here as a liability component, this is what our company has to pay in the next 5 years. This to the company is therefore like a loan. So being a loan to the company, automatically what do we need to do to this? This one we need to amortize. We need to amortize this liability. Because like what our company is required to pay in the next 5 years. So what we need to do is we amortize it. We amortize it. So we amortize this by basically preparing the amortization schedule. The way you amortize a loan, the amortization schedule. So here we will have our 5 years. Our 5 years. I think we can have just year 1, year 2, year 3, year 4, year 5. Although this specifically what this is not what the question was requiring. The question was just requiring the candidate to prepare this for just 1 year. That's why you can see you are required to compute the amount or the carrying amount to be included in the statement of financial position in the past year. That's why you can see the question has just 5 marks. Because we said, if, for example, the examiner requires you to prepare financial statement extract for the 5 years, that question should be you should be given at least 8 to 10 marks. 8 to 10 what? To 10 marks. So what we need to do, can we amortize this? I want us to do it for the 5 years so that you understand. So here we will have what? We will have, remember what we are amortizing is the liability. So here we will have the value, the liability